Why people look at EBITDA. In this lecture, I'll talk about the three main reasons why EBITDA is such an important level of operational profit that many shareholders, analysts, and directors prefer. First of all, just as a reminder, depreciation and amortization is not a cash cost. And EBITDA we get by adding back to the operating profit the depreciation and amortization. Therefore, we can say that EBITDA is, in a sense, estimation of operating profit if we took into account only cash operating costs. And that's why EBITDA is looked at by many people. So the three main reasons are: you want a profit that is impacted by cash costs only, and EBITDA fulfills this purpose. You want to have a nice proxy for cash generation, and EBITDA under certain conditions also is fulfilling this requirement. And the last reason is actually that it's widely used. So you use it because it's widely used and widely understood. There is another thing which is also important, is the fact that EBITDA is not impacted by the way you depreciate fixed assets, which may differ from company to company. So it is, in a sense, more comparable. Let's go a little bit deeper into those three reasons. As I've said previously, once you use the EBITDA, you, in a sense, eliminate the effect of the biggest non-cash expense, which is the depreciation and amortization. EBITDA, contrary to other profits like net profit, is also not influenced by the capital structure. So in other words, the cost of the capital. You have companies which have a big debt, and those companies with the same EBITDA may have a much lower net income. Another thing, as I said, is that it's a good proxy for cash generation. It is obviously under certain conditions. So we may say that it is very good for estimating how much cash we're going to generate from operational activities, provided the company does not grow heavily in revenues or the growth doesn't require much of a working capital. You will see it later on when we talk about the cash flow statements, but generally speaking, EBITDA is how much cash we would generate from the operational activity, provided we don't have much movement on assets, and this is usually done due to the fact that we grow in revenues. It can also estimate nicely the general cash the company generates for investors. In this case, we mean both the owners, shareholders, and the banks, provided obviously that CapEx is not required. So in a sense, a lot of people love EBITDA because it shows you, obviously, with rough estimation, how much money it will generate. And thirdly, as we said, the EBITDA is widely used, and this is used for three main reasons. So first of all, it is, as I said, not influenced by the assumed policy for depreciation and amortization that may differ between companies and also may differ within the same company over the period of time. So EBITDA is more comparable between companies than, for example, the operating profit. EBITDA, as we said, is a proxy for capability of the company to generate cash. Obviously, as I said, provided that it doesn't grow much, and therefore in many valuation method, you simply calculate the value of the company as EBITDA multiplied by certain multiplier assumed to be good for this industry. That is why in many bonus systems of the board members, you will find a reference to EBITDA, and also many investors will heavily report on that, and any change in EBITDA may cause the valuation of the company to go up or down significantly. So that's in short why people look at EBITDA.